All right, so let's get started with the live stream. To begin with, I am really liking the green on the screen that we've seen for 5 consecutive days on the NASDAQ. The NASDAQ's up 6%. That is great because if you look at the first couple of days of August, it began with a lot of crashing. The stock market went down 8% collectively from the end of July through the first 7 days of August. But the market has risen about the same amount that it dropped in the first couple of days of August in just what is 8 days collectively. I think probably about 5, 6 trading days in that time period. So we are back to even. And if I look at my portfolio, the first couple of days looked horrible, but I'm back to even, which is great. And I've collected dividends and interest on my bonds. So I'm back to even. We got about a half a month to go through the end of August. So we'll see how things shape up. Overall, the year has been good. On the NASDAQ, it's up 19% year to date. For the 1 year, it's up 29%. And if we measure from the very low period that it had in 2022 and really the beginning of 2023, the NASDAQ is up 68%. Beautiful. Man, what's there not to like about 68% rise? It looks like Best Of is in the live stream. Very nice that you joined. Hope you're having a very good day. Hope you have lots of gains in your portfolio. So overall, we're seeing a lot of green. And what's good about this situation that we find ourselves in is that we had the markets take some medicine, and they took some medicine and had some really high, stock prices kind of get tempered down, kind of get sold off. And hey, let's not get carried away with these really, really high stock prices. The whole irrational exuberance argument. Now that the market took its medicine, it's decided to really just go in rally mode. It's up 8.6% in, like I was saying, eight calendar days, which is pretty phenomenal. So from here on, I'm thinking, anything goes. The economy's doing okay. We had economic data get released this week. We had the producer price index came in showing that inflation is actually going down. Very good news. So the manufacturers, the producers, they're going to be buying their materials or items to put into their end products at a lower cost, which I would hope is going to then lead to lower prices to the consumer. The consumer price index came in lower than expected, and we're in the twos. We're in 2.9% inflation year over year, which is great news. The Federal Reserve has a mandate of keeping down inflation, and their target is 2%. And they also have a dual mandate. The other mandate is to keep unemployment, manageable. The good news about job losses is the job report came in, and new unemployment applicants, they were expecting a number. The number came in lower than expected. So we don't have an unemployment problem just yet. We have inflation that's been somewhat controlled by the Federal Reserve from those really high levels a couple of years ago. We were up in the nines, man. It was ridiculous. I remember eggs were like selling for almost $1 an egg, which was ridiculous. So now things are a lot better. So going forward, I'm not convinced that we are going to have a perfect economy. I don't think anybody's arguing that. I think we're going to have a soft landing. I'm seeing a lot of headlines where job losses are accumulating, right? Intel came out and said, hey, we have to let go 15% of people. That's a lot of people. Cisco came out and said, hey, we're going to reduce our headcount by like 7%. So you're seeing company after company, say, hey, we're going to have to let some people go. So we're not seeing those numbers in the unemployment just yet. And those are really good paying jobs. So we'll see how those things sort themselves out. But I think the unemployment rate is going to go up a little bit. That is going to be a little bit of a headwind for stocks, especially consumer discretionary stocks. 70% of the economy is the consumer spending their money. So if consumers don't have a job or are afraid they're going to lose their job or there's economic uncertainty, it's going to really reduce the spend by the consumer. So really where we were at roughly a month, 2 months ago to where we're at now, we're in a pretty good spot. I think there is enough concern out there not to let these stocks get too out of hand, but buying in the right places, I think we got really nice gains to make up this year and make some money. So, ex dividend, thank you for joining the live stream. Very nice to see you. Falls Grave, nice to see you again. Let's make some money. Let's figure out how to make some money. All right, so we went over the NASDAQ, just a quick compare against the other indexes. So we have the S&P is kind of like the benchmark. We have the Dow, the NASDAQ, and the Russell, which has really, the Russell has been the disappointment, period after period. We have like the last month, we had stocks go down across all the indexes. The Dow probably made it through the best. It didn't go down a whole lot, and it's really risen nicely over the last month. We look at the last 6 months, the Russell made some noise when it was deemed that the Russell is in the orange line. It was deemed that interest rates were going to drop, which really helps small companies. And the Russell saw a real big increase, but it's given all those increases up. And now it's just back to, the same old. The S&P's leading the pack. The NASDAQ is right there with it. And the Dow is not keeping up. And the Russell is in last place. Now, do I think that there's really good opportunities in small caps? Absolutely. I'm going to show you a couple today where there's some really strong arguments for those stocks to really rally in the future, especially around healthcare, especially in certain pockets in certain industries. There's really good opportunities out there. All right, so that's where we're at with the indexes. As we look at sectors, the sectors just for today, the sector that led all other sectors was consumer discretionary. And we had some stocks do well. Ulta, I don't know if you noticed, our friend Warren Buffett decided to invest in Ulta, and that really rallied. I think it was up 11% today. In addition to Ulta, Walmart came out, and Walmart had a very good quarter. That's a huge cap company. So there's good things happening for consumer discretionary, at least for the day. Technology really showed up. Technology really rallied across the board with a few exceptions, but technology did great. Materials had a good day. Consumer staples had a good day, but just keep in mind, consumer staples will not double your money very quickly. It'll take a long time. Now, the other sectors, the worst sector was real estate. And I've kind of talked about this in other live streams. Real estate's a good investment if you're looking for income or you see that it's going to work for a period of time, but have an exit strategy because over time, real estate will not double your money very quickly. I'd like to see my money double at least every 5 years. And it's really hard to do that with real estate investment trust. Utilities is right there with it. I've shared that I don't like utilities because they do this. They give you a nice income, but they don't appreciate very well. And it was in second to last place. And one surprise is communication services. That's where Alphabet, Meta, Netflix reside. It didn't do as great as the others, but it was in the green. The one that I'll point out that I am continue to be optimistic and bullish about is healthcare. It's green across the board. It is historically a very good sector. So these are pharmaceutical companies. These are healthcare insurance payers. So all kinds of good stuff happening in healthcare. And if there's a recession, no problem. Healthcare is good during recessions. If there's a lot of things that I like in healthcare, it's been kind of a forgotten sector that hasn't done great for the last, year to 2 years. And a lot of the compares are going to be very, very attractive to investors where they see that the companies have been growing, accumulating cash, buying back shares. And we're going to look at one company that is interesting today in Solventum. We're going to analyze it from soup to nuts. So we'll get to that. But it was a big green day. Very good. I can get used to this. I can get used to this very easily, just seeing portfolios go up. And it is kind of, my biggest complaint, when I was complaining about it back here was you can't have markets just go up and to the right. It's just, you're going to get irrational exuberance. We're going to get ourselves into trouble. We're going to have a big freaking crash. And I don't want that. We took some medicine and I feel better. Okay. All right. I feel better. We let some air out of the balloon. Let's go ahead and let the markets run. So we'll see how far they run. All right. So if you guys are interested, we'll look at what super investors are doing. We've got super investor data out. I did a video today. Hopefully you had a chance to look at it. But I wanted to look at Warren Buffett's portfolio in a few minutes. Let me catch up on some comments first. All right. So the Family Guy, how you doing, man? Good to see you. Did you see ASTS? ASTS. 50%. Oh my God. What is this company all about? ASTS Space Mobile, together with its subs, develops and provides access to space-based cellular broadband network. Wow. What happens? Something got connected and turned on and so forth. So climbing after the space-based company said its first 5 commercial satellites will launch next month. All right, so their satellites go up into space, and then they get connected, and they give connections to subscribers, and they will very quickly start making money. Right now, they're pretty much pre-revenue, right? They're not making any revenue. In 23, they made 0. So having said that, they're probably going to go from 0 to, I don't know, 100 million, 500 million, and that's really exciting investors. Now, I would say that this is a game that I don't play unless I know this company really, really well, and I know this industry really, really well, because a lot of things can happen. I was following a company in their industry by the name of Viasat. They are doing the same thing where they launch satellites into space and they give people broadband connections. The only problem is they launched a satellite. It was a multi-billion-dollar investment. It got up there. They hit the button to turn on, and the darn thing wouldn't turn on. It was a complete loss of that investment. So a lot of things can happen in space. You know, you have a satellite go up there and it doesn't work. You can't call AAA to go fix a tire. You can't call NASA and say, hey, could you go fix our satellites? They're like, no, we got more important things to do. We're going to manage satellites there, maybe for the Defense Department and things like that. So awesome that this stock went up 50%. Hopefully some people on the live stream had, money in this company and made lots of money today. I hope you did. But this is not an investment for me, but it's pretty darn exciting, to say the least. Analysts are saying it's a strong buy, but it's being priced at a premium of 29%. So obviously their analysis has to catch up with reality. All right, so let's take a look at XDiv. At Victory Age, what market capitalization is this stocks? That's a very good question. So what's a small cap, medium cap, large cap? So if you would ask me that 10 years ago, I would have said, a big cap stock is a company above 100 billion. But for Pete's sake, man, we got companies that are just incredible valuations, right? Let me try to find the so we got companies that are north of $3 trillion. It's just insane. Apple is 3.4 trillion, Microsoft 3.1 trillion, Nvidia 3 trillion, Google Alphabet almost 2 trillion, Amazon 1.8 trillion. This is trillion, 1,000 billion. 10 years ago, I would have said, oh yeah, above north of 100 billion, that's a big cap. Probably 20 to 100 billion would be maybe mid cap, and then under 20 billion would be smaller cap. Micro cap would be under $1 billion. Today, I mean, I don't know what to tell you. It's like, holy smokes, man. So I guess my definition of small cap would be under 100 billion, under 75 billion. I don't know what you would think, but look at the valuations of these companies. They're massive. Big cap now is like, okay, to be big cap, you got to be 500 billion and above. And maybe the middle ground is 100 to 500 million is mid cap. I'm totally, spitballing at this point, but hopefully you get my point that, the valuations have gotten so high that I don't want to use historical measures, because historical measures just don't make any sense. Micro cap historical measures are, oh yeah, that's a company under $250 million in market cap. That doesn't fit any of the valuations today. Small caps are under $1 billion in valuation. Yeah, right. That's like doesn't even register on some of these valuation charts. So I would say that, small cap, if you're in the under 100 billion, maybe under 75 billion, I would say you could argue that's a small cap, especially around 20, 25, 50 billion. I now think that's the sweet spot of small caps. Mid caps, like I said, maybe 75 to 300 billion. And then north of that would be big cap. And then there's the mega caps that are above $1 trillion. So good question. That's how I see it. All right. The Family Guy is, oh my God, it was $4 in May, not sitting at 30. Man, I hope you made lots of money on that, Family Guy. Solventum, great. Spin-off companies. Yep, I agree. We're going to take a look at that one. We're going to go from nothing to an evaluation, and then we'll see what kind of decision I'm going to make on that stock. Okay, good question. How much do I decide to invest in a position? So it's a couple of things. One is, the company, am I really confident in the company? That would be, okay, I'm going to invest more. What is my confidence level in the execution of that company? That's another factor, raising the valuation. How risky is the company, right? If they have a really strong balance sheet and it's just over time, like Alphabet, Google, I've got over $100,000 invested in that company. Let me go ahead and show my portfolio for that sake. So I will sort from largest to smallest, and you'll see that like where I put most of my money, right? Meta, Alphabet, Chevron. I mean, these are names that we all know, but now we're getting into my bets. Airbnb. I've put $87,000 into Airbnb. My comfort level of the industry is really high. I think I've shared with you. I rented properties as a real estate investor on Airbnb. I really believe in the company. I bet 87 grand. Uber, 42 grand. Elevance, which is a very solid healthcare payer, 50 grand. Kroger, I know them. I've known them for a long time, 50 grand. CTRE, which is a REIT, 33 grand. PayPal, 46 grand. So these are names that, I can get my head around. I have a confidence level. As we get into like Ternium, this is a little bit higher risk, 42 grand. Pfizer, 31 grand. And I think that's a really good recovery. Alibaba, I'm kind of pausing my investing there, 31 grand. Now, how do I build a position? So I don't buy, like, I'm not smart enough to look at an investment and say, you know what? I'm going to, like, one of the investments I'm starting is with Live Nation. And I'm not like with Live Nation, it's a smaller company. I don't own any shares just yet, but I'll probably start with like $1,000 and then I average my buying in, because it's really hard to, let's say we're looking at Live Nation and we look at the 1 year chart. Man, this thing's all over the place, but I could probably pick a zone where I'm like, it's probably a good time to buy, around here. Like one of the things I'm having trouble with, I finished my analysis on Live Nation, and then it decided to really start rallying, which is, makes it harder for me. I'm trying to pick, a good zone to buy the stock in. So what I try to do is I average my purchases around some low spots and some pullbacks in a stock. A Live Nation-like company, it's smaller. This is, I would consider a small cap. It's $21 billion in market cap. And I want to invest $10,000 to $20,000 in Live Nation. Own it for a while, make sure that they're operating really well, make sure that I really get to know the company and really like it. Could I see myself investing $40,000, $50,000? Yes, maybe in about a year's time, maybe 2 years. So I invest, and then I continue to monitor that investment, and then invest over time. Like with Meta, I've been buying stock in Meta over years, right? And I try to buy in zones when I think the stock price is misunderstood and it's discounted. And I buy it over time to dollar cost average my investment in that company. I'm not smart enough to say, oh, this is a perfect point to buy Live Nation. I'm going to buy 10 grand or 20 grand of Live Nation on this day or on this day. I'm not that good, nor am I foolish enough to think that I would ever be that good. Nobody's ever that good. You just need to figure out these are quality companies. Over time, I want to own more shares, and I'll let the market do what it does. The market will prove to us that it will go up and down. It'll go up and down. And what we got to do individually on stocks is use the momentum of the market in our favor. If it's a stock we really like, have done our analysis, did our homework, believe in, hey, let's buy into it because the market doesn't understand it as well as we do. And boom, buy when the buying is good, when it's discounted. So that's how I invest in a company. I try to make the investment size around basically risk. If I believe in Meta, I believe in their future. I'm going to let the money ride. It's 10% of my equity portfolio. And I have a portfolio of real estate, which is not included in that number. I have crypto, which is small, but not in that number. And so that's how I go about, deciding how much am I going to invest. All right. So Anderson, video on Live Nation would be great. Been in and out in it occasionally. So I got good news for you. I already finished the video on Live Nation. It's going to release, I think, on Saturday morning, because I have a couple of videos ahead of it. I think tomorrow morning, Alibaba is going to release in the morning, and then there will be another video in the afternoon. Then Saturday morning, you can drink some coffee and watch Live Nation. It is a stock I've been in and out of myself, and I've made money on it. I like the company. They're the leader in their space, and I really think very highly of the company. Watch the video, and you'll see more details on that. All right, so we got to all the comments. Now let's go ahead and let's do Solventum, and then we'll come back to Warren Buffett's portfolio. So Solventum real quick, and I could probably tell you about this company by showing what they do. First, they were a spinoff from 3M. 3M is a high-quality company. I certainly believe that. I think most people that have been in the business world really respect 3M. They've had their issues. They released some earplugs. They sold earplugs that caused hearing loss for some servicemen and women, which is really bad. But I don't think they meant to do that. And they've resolved that through the legal courts and have paid the money that they should have paid. So that being behind them, they decided to really focus their business, which was a good idea. And they spun off Solventum. Solventum focuses on providing products for healthcare, for surgeries, for hospitals to use. They also have systems that hospitals use to manage the operation and maybe the billing. They also do dental products. So your dentist, when your dentist is working on your teeth and so forth, they might be using Solventum products, which were previously branded with 3M. Now, the company was a spinoff, and it's coming from a quality company, in my opinion, and it's being spun off. Now, some spinoffs have been really, really good. Some spinoffs, not so good. Now, my biggest concern with the company was I didn't have enough data. Everything was being communicated as this is what we think we're going to do. So I wanted to give it a quarter or two because I was given shares because I'm a 3M stockholder. And I sold my shares and said, I need to see some data before I make a decision to buy more shares and even hold these shares. So what I'm going to do is we have the financials from the quarter that just ended. It was reported about a week ago. So let's put this guy on half a screen. Let's get the valuation model. And I have not updated Solventum, but let's do it on the fly. If we can find it, let's see here. Am I not tracking it? Okay, let's go ahead and just start it from scratch here. All right, so I'm going to go ahead and copy my model and just start from scratch. Just recreate one for Solventum. This is for Solventum, and it'll also tell you kind of like how I think about it, right? Solventum is new. It's not as well known, so I'm going to increase the discount rate. I want a higher rate of return because it's an unknown company to this point. It's really unknown how much they're going to grow, but it's going to be modest growth. I'm going to leave these factors here alone. The growth rate in cash flow, this is healthcare, right? Healthcare is steady. Healthcare is really nice and steady. I'm going to play it safe, 5%. I'm going to leave it at 4% for long-term growth of my cash flows. Now we're dealing with a key input into my model. I value companies on cash flow and I value companies on earnings per share. Real quick, I value companies on cash flow because the top most valuable companies, if you look at them, they produce high cash flow and they've shown a track record of growing their free cash flows. That's why Apple is worth $3.4 trillion. And the second player, Microsoft, look at their cash flow. That's why they're worth more than $1 trillion. So I use cash flow. So let's take a look at Solventum's cash flow. I'm going to reduce this guy to a smaller position. So this is cash flow for the first 6 months of their current year. And it's cash flow is cash from operations minus plant, property, equipment, which is CapEx. And the reason there's logic in that is the business produced all this cash that the owners get to use. They can use it for dividends. They can put it on the balance sheet. They can acquire other businesses. They can buy back shares. But CapEx represents how much money they have to put back into the business. So it'd be like owning, a business, let's say a pizza shop. Now, at the end of the month, your pizza business, or at the end of the quarter, your pizza business gives you $2,000 or $5,000 in free cash. But every end of the quarter, you got to buy a new oven. And then the next time you got to buy this, you got to buy the other. It's almost like you're recreating the business every year. That's a bad business. But if you have very little CapEx, that's a very good business. If you have high cash flow, low CapEx, that is Google Alphabet. That's Microsoft. That's Apple. So that's why we want that ratio to be high operating cash flow, low CapEx. In this case here, it's 797 minus 160 for the first 6 months. So that's for the first 6 months. So I'm going to do the formula here with you. Hopefully you guys could see it. And I'm sorry if it's a little bit hard to see, but I'll talk you through it. So we got $797 million minus $160 million. That's for 6 months. So I'm going to multiply it times 2. So that's for the year. For the year, I'm expecting they're probably going to do about $1.2 billion in free cash flow for the current year. I'm going to leave it there. I'm not going to increase it just to play it safe. And these numbers are going to be growing at 5%. So the forecast is they're going to do $1.2 billion for the first year. Then it's going to grow by 5% for the years 2, 3, 4. Terminal values, all cash flows beyond year 4. Those are going to grow at 4%. I'm going to discount. This is like saying, they're going to deliver all this cash to you. And let's say you were the sole stockholder of the company. You'd get all that cash. The net present value of all that future cash is going to be determined by discounting it based on the rate of return that you want on this stock. In this case here, I want 9%. And based on a 9% discount factor, we get an intrinsic value of $24.3 billion. That's what the company is worth based on the free cash flows I expect the company is going to produce. Now we need to know how much cash do they have on hand? Well, they gave us a financial statement. So we got the balance sheet. That's where we know how much cash they got. Cash and cash equivalents, $897 million. All right, we can pop that in there. How much debt? Debt's important. Long-term debt, $8.3 billion. And then they have any in the current. Nope. So we got just $8,306 million. That's how much debt. So the present value of all the cash flows I expect plus the cash minus the debt is the equity value of this company. That's what that company is worth to me. Now, when I look at Solventum and I look at their current market cap, they are a $10,160 million company. All right. Shares outstanding is they've got 172.71 million shares outstanding. So the intrinsic value per share is $98. Their current stock price is $58.84. So there's a 67% discount on this stock. If we look at the cash flows that they're going to produce, and we want a rate of return of 9%, it gives us a discount of 67%. Cash flows. Cash flows, number one method that most investors use. Warren Buffett, Charlie Munger. You look at those types of Pat Dorsey, read his book, Cash Flow is King. Now, I also like to look at earnings per share, and I weigh that with free cash flow method, because sometimes a company has tremendous growth in earnings per share, and temporarily their cash flows are low, but eventually they'll be high. With this company, it's expected they're going to do $6.36 in the current year. All right, so let's put that in this formula here, $6.36. I'm not going to give them a PE of 24. They're too young and unproven. They are growing. They showed growth in their financials. They grew slightly. So I'm going to go with like 16. I like their industry. I like the fact that they are in healthcare, which I believe is going to do well going forward. I like a lot of attributes with Solventum. And the current stock price is 58. So there's actually a big discount if we look at earnings per share. We can even lower the earnings per share to 12, which is really, if you read Benjamin Graham's book, is if you have a company that's profitable, producing cash flow, growing, it deserves at least a 12. Sometimes the market just discounts a stock beyond reason. But in this case here, we are looking at a stock that is discounted, blended at 55. My blend is this way. I take two parts. 2/3 of the valuation is free cash flow. 1/3 is earnings per share valuation, 55% discount on Solventum. All right. So we know it's discounted, but do we want this business? Do we think this business is good? Right. So let's talk about Solventum. So Solventum are they highly desirable, okay company, or not desirable? Highly desirable is, hey, these guys, they got competitive advantages. They can keep competitors out, therefore grow really well, be profitable, and generate a lot of free cash. Okay, that'd be the green. That'd be like Microsoft. That'd be Google Alphabet, Amazon. Those guys are super strong, great barriers. Or are they just kind of middle of the road? They do have some advantages, but overall, just not tremendous advantages. Or are they on the red? Hey, it's a donut shop. Anybody can open it. You got competition everywhere. Prices are really low. Profits are really low. No cash flow to really speak of. I think that Solventum is probably clearly in the gray. And you could argue, yeah, they're in the gray, but you could also say that they're probably crossing over into the green, because they do have some patents on some of the med devices that they have for surgeries, dental practices. The other thing that you can argue that, they belong partially in the green is that their relationships with dentists, the kind of like the network effect, the relationship with hospitals, doctors and hospitals are accustomed to using Solventum products for surgeries, and they don't like changing that stuff all that often. So they have stickiness in their business. So if they can start growing, I could definitely see them. Hey, it's going to be very hard to replace Solventum. They got established relationships, that focus in the company of, hey, they're a spinoff from 3M. That real focus on med device is going to really help this business. So I like Solventum. I like the discount at 55%. I like the pedigree of the company, that they came from 3M. So I'm going to be buying Solventum stock going forward. I'm going to put a nice buy order in on this company and just start building a position. Back to how much I'm willing to invest in Solventum. For now, I'm willing to bet $5,000 to $10,000. I'll build the position up. I like starting with about $1,000 investment and then building it up from there. I'm going to put Solventum in my portfolio. There's mostly income-based stocks, because this stock will eventually pay a dividend and it'll be the right place for it. So that's how we got to a valuation on a company. And let me try to fix my screen here, get rid of this stuff that I did on the fly so it's not ugly anymore. All right, so that's Solventum. Solventum, let's see what analysts say about the company really quick, and we can finish our review of Solventum. So the company hasn't existed that long. They were issued out as a new, or spun off less than a year ago. So far, down 35%. I think people are waiting to see what the heck the company's about. The last month, man, they're rocking. Look at them go. Last 5 days, down a bit. Man, you know what? I'm going to buy probably tomorrow. Unless the market, if I wake up and they're like, oh yeah, Solventum's up 10%, then I'll be like, man, I'm going to have to wait a little bit. So that's where I'm at with Solventum. I like the company. I've been tracking it for some time. I knew the spinoff was coming a year ago. It happened. I've got enough data to be comfortable. I think a 55% discount is going to be potentially rewarding enough for me to take the chance and buy stock in this company. So, all right, we did a valuation from scratch. All right, this isn't a cooking show, but we just created a valuation from scratch. So hopefully you guys liked it. All right, so where are we at with these comments? Let's see here. Anderson, cool. Thank you, sir. Thanks for covering Solventum. You have shares? You used to hold 3M like I did. Yeah, I got shares as well. I still have 3M. I love 3M. 3M's done great. And you know what I love about 3M is, so I'm 55. I'm a fan of the United States of America. I'm a fan of companies who created value for our economy, for people. 3M is a storied company. They have innovated over the years. To me, the 3M brand is right there with like Disney and right there with like Apple. It's a quality company. Now, they made some mistakes. Understood. I recognize that. But I don't think they meant to do it. You know, they created a product that was faulty. They admitted to it. They took care of the people that were injured, and we move on. So when I see a stock like that come back, you know, and this doesn't really show it. You see the fall that they took. They were trading at $200 a share, and the market said, we're going to punish you because you made some mistakes, and we're going to punish you. But you look at what it's done lately, and this doesn't show it all that great, but the last month up 26% year to date. You know, that's kind of terrible graphing. So let me go here. This will show us a better view where I could, you know, show you, like, I started buying and believing in the company. And from there to here, 66%. Boom, go 3M. So one of the good guys is winning. 3M, I think, is a good company. They came back. I think from here, they're just going to keep getting better. They produce a great dividend. Look at this dividend. Right now, it's 2.2%, but that's because the stock price has jumped up. If you're buying here, you really have a dividend yield of 5 to 6%, and now appreciation of 66%. So that's awesome, man. I love seeing that when one of the good companies, you know, they have a tough period of time, stock market punishes the stock price, but picking it up at the right time, believing in them, and then watching your investment fly up. I love that, man. All right, so XDiv spinoff. Man, I can't read that. I think that's German, and I don't read German. I'm sorry, but maybe this next comment is a spinoff shares. Large institutional investors often do not want these shares because they do not fit their concept. Yep, that's you nailed it. Which is you're a 3M investor and an institutional investor. You're like, okay, this fits a particular purpose for that portfolio. Hey, you gave me these shares. I don't know what to do with them. Sell them. I can't manage them. In my case, I was just like, I don't know this company. If I don't know and I don't understand, I sell. I don't invest in stuff like that. Now that I have more information, I'm willing to buy. I'm willing to buy, and I think other investors are going to wake up to Solventum as well. So very good point, sir. So institution, I think just a little more detail on your comment. Great call on Zim. Zim, baby. God, man, I think Zim, I'm glad you brought that up. You know why? Here's why. So Zim was left for dead, right? I mean, I love these stories, right? When we got into the COVID years, shipping rates just went through the roof because there was a scarcity of products. So all of a sudden, companies had to really pay really high shipping rates. Like rates went up like 5 to 6x. So shipping companies like Zim were just making money like hand over fist. They were making so much cash flow. This company had a dividend of 25 or 50% of its stock price. You heard it right. You owned a share of their stock. They gave you back 25 to 50% of the stock price. Ridiculous amounts of cash flow. So they got a bunch of cash. Now they did something smart. They said, hey, we got all this cash. Let's buy new ships that are more efficient. They're going to make us more competitive, stronger, better, faster. But the market said, oh, you're not going to make the kind of money you were making during a huge pandemic that led to a huge supply chain constraint. All right, we're going to sell you off. And they sold them off just without any reason at all. Now, I studied the company, looked at shipping rates and said, well, based on shipping rates, these guys are going to turn a profit and they're going to keep generating cash flow to the point where I believe Zim is discounted, and started buying shares. I bought shares at like $10 a share. The stock is trading at $18 a share, $19 a share. I have an exit strategy where I want to sell at $30 a share. Now, we had a retail report, I believe today. Retail sales went up. The consumer's spending money. Well, when the consumer buys all the stuff at Walmart, Walmart has to order some more stuff and have Zim ship it across the Pacific, or ship it across the Pacific through the Panama Canal over to Europe. They have to ship a bunch of stuff. So Zim volumes are going to go up, and shipping rates have been somewhat reasonable, meaning that Zim is going to turn a profit. Zim has earnings coming up, and I am really looking forward to it, because my bet is that on August 19th, where they announce earnings, this stock's going to do well, because the market just continues to bet against Zim. They continue to say, you guys shouldn't exist. We're going to sell you off. We're going to sell the stock by 91.8%. That's like leaving a company for dead. But what happened between the peak and this trough? They bought new ships. The supply chain for the world didn't go away. Companies still have to ship product from China to Europe, Europe to other places, United States to other places. And where do they do it? On Zim. So this has been just a really good opportunity. This is a small cap stock, especially where I started. This is $2.28 billion. These guys can double, and none of the institutional investors even pay attention. But if you look at some institutional investors like JP Morgan and some others, they've been buying into this company. So I think the word's getting around that, hey, you know what? This little company is going to kick some butt. And I'm really glad that I picked this stock up. I'm really glad that I didn't invest right away. I started studying it, and then at the right time started to buy into the company. So I feel good about that investment. And what I also feel good about is when a business, kind of gets left for dead by the market. What the heck, man? That's totally unfair to Zim. It did not represent the company at all. So the market didn't understand the company. I think they were overplaying the downside. That's okay. I will take advantage of the market being wrong and buy dollar cost average my investment, and then get a nice appreciation out of the stock. Thanks for calling that out. I appreciate it. That's a fun one. In case you haven't noticed, I love this stuff, man. I love finding companies like that and investing in them and then betting on them. Speaking of which, let's talk about Chegg. Chegg fits the same mold. You think about Chegg, right? During the pandemic, these guys, if you don't know who Chegg is, Chegg does basically, it's a tutor service, or if you're studying calculus, or some really difficult science in college or in high school, and you're this whiz kid, which frankly, I'm in Southern California, and kids are so darn smart now. They're taking like college courses sophomore year, junior year. These are super hard mathematics, man. And what they do is they subscribe to the service where Chegg has a lot of good answers to questions and really know-how of how to learn a particular very difficult topic. During the pandemic, when they told kids, hey, you got to go home and get on Zoom. So the support to that student really went down, right? You didn't have, office hours to go talk to somebody and say, hey, I don't get the trigonometry. I don't get the, molecular biology. I don't get the this and that. So their stock just flew off the charts. And then again, the stock market said, we don't believe in Chegg. We're going to sell it off 98%. This company is worth 2 cents on the dollar. 2 cents on the dollar. Nuts. But as we study the company, their revenues have fallen. But when we look at Chegg from a cash flow perspective, you think about 98% being sold off, 2 cents on the dollar. Well, are they completely worthless? No, they generate free cash flow. So when we look at cash flow, they continue to drive free cash flow. And their cash flow yield is very good because their market cap is so darn low now. So the trailing 12 months free cash flow is 82 million. Their market cap is 204 million. 82 divided by 204 is roughly about 38% yield on free cash flow compared to that market cap. Now, I continue to say I've been nibbling at Chegg, just buying a few shares, averaging in my investment, because I believe that if these guys start to grow and their growth rate is not super bad, they're losing sales, but not like, oh, they lost 50% of sales. If they start growing, look out. If they make their AI product, which they developed an AI product to help students with learning really tough subjects, look out. These guys are just going to crush it. And they may be an acquisition target because another company could come in and buy them and buy all that cash flow, the know-how of how to, deliver the right lessons and tutoring to students, because these guys know that stuff. And as I hear from other students, now I've got 2 college age sons. One of them studying a PhD at Penn State. The other one's studying economics here at Long Beach State in California. The Long Beach State attendee, I talked to him about Chegg, and he has a subscription. And he said that for subjects that he takes on, yeah, you can use ChatGPT. Yeah, you can use, Gemini from Google, but they maybe answer some of the easy questions, but the hard questions, you really do need the support behind Chegg. Chegg has people behind the service that really do provide the lessons as they should be taught and give that student the right support to get over and complete that class and learn the subject really well. I also heard just today or yesterday, another community member on the Chegg video, he put in that, hey, he's a graduate in a science, and he said that Chegg is very useful. You cannot learn the really difficult subjects on ChatGPT or Gemini or Meta AI. Those will get you the standard answers that get you through just elementary courses. But the hard courses, you're going to need Chegg. So that's it really bodes well for this company. We'll see if they make it. For all I know, I'll be wrong and I'll lose some money. But I believe that I'm going to be sitting on a multi-bagger at some point. It might take a little time, maybe about a year, but we'll see. Remind me of it. If I crash and burn, I commit to showing you my crash and burn scenario, how much money I lost. And the flip side, if it works, we'll see how it worked. All right. So DRI Biz. Yeah. So there it is. So you're kind of agreeing with, my logic that, like Zim's a good example where, yes, the situation isn't as good as it was a couple of years ago, but it doesn't mean that in the case of Chegg, you sell off the company, you sell off 98% of the value of the stock. That is just ridiculous. It's like the company's worth, let's just say the company's worth 20% of what it was worth a couple of years ago. Well, that's like a 5-6 bagger from this stock price. I'll take that gain. There's no shame in making money from a company that's a $2 stock that maybe goes up to 10. I've done that with other stocks, like Big Five was down to $2 and it got up to 40. Thank you very much, stock market. So we'll see where it goes. Man, Mercado Libre. This situation, I did a video on it. You know, I love finding stocks, but sometimes they torture me. Let me tell you why. I I saw Mercado Libre. I'm like, these guys are doing good things. They're really getting their business in order. I saw that there was an opportunity. I analyzed the company. I got to this point after my analysis, and I'm like, I'm going to buy this stock. And then it goes on this rocket ship ride. And I'm like, oh, you guys are killing me. Where do I buy? It's been up 24% since I finished my analysis. So it's, I guess, small victory of being right that, okay, I guess I found a stock that was good, but it just tortures me that I couldn't buy at least a few shares and then take the ride up. Mercado Libre is great. Now, I'm not buying shares for the good reason. You may have heard of this company, Amazon. Amazon presented me a really good opportunity. I've been an Amazon stockholder before, and the market decided, you know what? Amazon's not as good as we thought it was. We're going to discount it by 19%. So I quickly said, thank you very much, stock market. So I started buying a lot of Amazon. I will buy Amazon at that discount. Thank you very much. So now that I'm loading up on Amazon, I'm not going to buy Mercado Libre because I also own Baba. So I don't want to have too many of the same, if you know what I mean. I'm going to buy Amazon. I'm going to buy it as fast as I can until it really exceeds its intrinsic value. But this is a really good opportunity. And this is, I mean, I'll put 100 grand on Amazon. Amazon's one of the great companies of the world. So that's my story on Mercado Libre. Man, you got to love this game. But sometimes, you know, like I was just describing, things don't go your way. You checked all the right boxes, did your analysis, you're ready to go. And then the market says, not so fast. I'm going to screw it up for you. All right. So we agree that Chegg provides great value. And let's see here. Falls Grave, BWLD. What's your thoughts? All right. Let's take a look. BWLD. BWLD. So I'm not finding it on stock analysis. BWLD. I'm not seeing any matches. Am I getting it right or wrong? BWLD. Please comment. Help me find that company. We'll take a look at it. Yeah. So back to Chegg. If they own all that data, wouldn't it be interesting for Google Gemini or Meta AI or ChatGPT to say, hey, we want to buy you because we want that large language model? Absolutely. Sergio, what's up, my man? Coming from Portugal. Thank you, sir. Good night, buddy. I know it's getting kind of late in Portugal. Someday, I'm seeing people in the community all over Europe and Morocco, some Asian countries. Man, if I can get out and visit you in Portugal, I would love to do that. And I got to get to Switzerland because we got a guy in Switzerland. We got multiple people in Germany, UK. Man, I'll take a tour of Europe and I'll come by and grab a cup of coffee with you. All right, so let's go with Bad Omen. How you doing, sir? You're one of the originals. Thanks so much for tuning in, for all your support along the way, buddy. Nike's rocking, baby. Nike is doing great. So Nike is one of the great stories, or one of the great companies, I believe, in the United States, because they've just did so many things right. And keep in mind, if you watch the Nike movie that has Matt Damon and Ben Affleck, right? They tell the story of how Nike used to be the small shoe company against Adidas and Puma and Converse, right? And they were the little engine that barely could. And now they're the big giant company that did a lot of things right because they continue to innovate. They continue to be obsessed on making the best athletic shoes possible, getting the best partnership with athletes, having the best ecosystem. They continue to be obsessed. That's why I started buying into Nike, because again, the stock market will act very irrationally and emotionally and say, Nike's no good. Nike's no good anymore. Nobody's going to buy sneakers. So we're going to discount the company by 41%. Nike basically had flat sales. How could you say Nike is 41% to the worse? It's just irrational. So I started buying shares, and luckily in the last, really couple weeks, it's up 16%. And this was, I may have bought a little early because I took this ride down. And if you saw my videos, I took this ride down because I started buying here. I doubled down on Nike. I bought a big amount of shares when this happened, and I continued to buy. And now it's beginning to work because we're dealing with Nike. Nike is the number one athletic shoe company on the planet. Anybody who wants to debate that, I mean, just look at the facts. They are clearly in the green. They have shoes in every category. Retailers want Nike on their shelves. Their power in the retail, in the world, in athletics, their brand, all those things, Nike is in the green. They don't have any competitors. They don't have a competitor that rivals their scale, their creativity. So having said that, if Nike begins to grow, boom, I think the stock will be up 50%. And it's a company that, frankly, we all know. We know it's a solid company. Their balance sheet's in really good shape. They produce really good free cash flows. The discount isn't what we saw with Solventum. It's in maybe the 20, 30% range. But overall, I think this is one that is going to have expanding value, pretty much like the Apple story. They just continue to expand their value because they were the number one player. So I'm really glad that I invested in Nike, believed in, the most powerful athletic shoe company in the world. And, it may seem like I'm exaggerating it, but you go into any sport, especially here in the United States or international football, we call it soccer. The number one piece of equipment that is related to sponsorship is footwear. Basketball, football, baseball, soccer, international football. Those brands are connected to those sports, all the passion, all the intense, loyalty to those brands and those players. They really channel that. They really monetize that. No better example than Michael Jordan, right? With his Air Jordans. I mean, that shoe's been selling for, God, like 40 years. And it's still like a top selling brand. So love the Nike story. Glad I bought into them. Hopefully you made some money on them as well. Google. Let's talk about monopolies. So when I'd be glad to, and I'm glad you brought it up. So Google's clearly has moats that resemble a monopoly. I agree. They're a monopoly. Now, they have expanding margins, expanding business top line, great free cash flow. We can look at the Microsoft example of how things are going to play out. First, it's going to take a long time for the courts to get the whole case kind of processed. To begin with, there was a decision. Now Google has basically challenged the ruling, and it's going to go to another court, and it's going to take maybe 2-3 years for that the challenge to be heard by the courts. So they appealed the decision, which is their right. So it might be 2, 4, 5 years before this thing ever kind of gets finalized. Once it gets finalized, then they're going to say, okay, well, we don't want you to do this. We don't want you to do that. Similar to Microsoft. It might be 10 years from now before they say, okay, Google, you have to leave the door open to other platforms that do search to compete for advertising dollars. By then, we have 10 years of AI, 10 years of innovation. I mean, all these things. The thought of breaking up Google is just not going to happen. The United States is too smart. They didn't break up Microsoft because they're like, hey, we're not going to tear up one of the most successful companies in our country that employs how many employees, that's created so much value. Yes, they did some things that were wrong. Microsoft took Netscape's business for the browser. They took it away. They did it in a way that was crossing the line, in my opinion. Google's never done anything like that. They were just so damn good, they drove everybody out of the space. Well, why? I mean, are you going to go to the Olympics and say, hey, Simone Biles, that gymnast that's super good. Oh, you're too good. We're going to make you, we're going to limit your performance by, limiting what you can do. No, that would be completely unfair. So if Google got there on merit, why the heck are they making them maybe give up some of their advantages? We'll see. But let's say 10 years from now, they start applying some of these rule changes. I don't think they're going to be that dramatic. And I think people are going to forget about this, especially as we see a new paradigm of computing and search, which is artificial intelligence. How will artificial intelligence change the process of doing search? Right now, we go to that beautiful, simple Google search bar and type in, this is what we need. Well, in the future, it may be different. So the Department of Justice 5, 10, 20 years from now is going to go, oh, well, what we thought you were doing wrong back then is completely different now. So we're kind of not going to do anything. So we'll see what happens. But if you look at Microsoft, they're doing okay. They're above $3 trillion in market cap. And they were dealt a similar situation 25 years ago. And they did things that were far worse. They actually really thought about and executed a plan to take NetSuite out, one of their competitors, illegally by forcing the PC makers to put their browser in. And if they went with Netscape browsers, they would basically not sell them software, which was using their monopoly, pretty much kind of like, the oil baron for Standard Oil, Rockefeller. He would basically push his supply chain around. And if you did business with his competitors, he would not do business with you. He'd really force your hand. That's what Microsoft was doing back then. Having said that, they kind of were okay as an end result. And I think that Google's going to be fine. I think that's just really bad press right now. But in case you haven't noticed, they released their AI phone on their Pixel phone. It looks pretty darn good. They have Gemini completely released. They have a lot of things going for it. They have the robo-taxi business and Waymo. Their search business has never been better. YouTube's never been better. #1 streaming service on the planet. You have your Google cloud business is growing faster than AWS and Microsoft. A lot of good things going for Google. That's one of the stocks that I continue to accumulate. I bought shares today, and I bought it on the low point, made a few bucks as it rose. But I've been buying Google really consistently for years now. So I'll continue to grow it. The only reason it's not as much as Meta, I've invested more money in Google, but Meta has performed better. So it's worth more money. So we'll see what plays out. But those are my thoughts on the Department of Justice situation with Google. So what do you think about Santander PE6? So I believe that's a bank or a financial services company. And yeah, so I believe. So I don't know that I'm looking at the right one here. So banks, especially, so here's if my recollection, because I looked at this company a long time ago. Are these guys out of Spain? Let's see here. Madrid. Yeah, this is it. So this is a Spanish bank. And I looked at them years ago and I thought, interesting. Now, it's not the right investment for me. I'm in the US. I don't know enough about this bank, and I don't know about all the inner workings of the Spanish banking system. I can just tell you I've made good money on Citigroup. And I thought the banks were completely sold off in 2023. Similar story to Zim, similar story to 3M and so forth. Made good money on Citibank, made good money on US banks, sold it, took the game. Now, the same thing may be happening for these guys because you look at their PE 6. Let's look at their growth rate. They're growing. Well, let's look at their loan rate. Okay, so total interest income. How is it that this bank is growing at a very good rate and their PE is this low? There's something wrong here. There's something wrong. But the stock's been doing well, man. Up 20% 1 year. Year to date is 11%. I mean, it's not breaking any records, but it's had a pullback and you're getting paid 4% dividend. I'm seeing a lot of good things. Not the right investment for me. I own Citigroup. I got my bank I'm good. I like Citigroup. It's in my country. I'm good to go. But this is a good idea. If I lived in Spain and knew that economy better and kind of understood these are the players, this is where the economy's going. I'm liking the growth. I would also look at their book value and see if they've been growing their book value. Let's take a look at their book value growth. So we want to look at balance sheet. So their book value, you want to look at, for a bank, you want to look at book value, and that has to be growing. If it's not growing, and I think I will have it on their balance sheet here. So this little website, I don't get paid any money to use it, but it's so damn good that I got to keep using it because it makes my job and my analysis that much easier. So book value. Look at this book value. Boom, 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 boom. Growth, baby. This is looking good. I like Santander. I'm not pronouncing it right, I'm sure. Banco Santander. Santander. Hopefully that was close. Sorry. I'm not in Spain, obviously. So I'm liking a lot of things I'm seeing, guys. This is $72 billion market cap. They are in Spain, so I don't know if there's lots of taxes and stuff out there, but this looks really good to me. So that's my opinion on it. Good luck with it. South Africa. Yeah, baby. All right. I got to get down to South Africa and check out that beautiful country. Somebody I know took that trip. He went to, he loved it. What's that big city in South Africa? And then he did a safari. Man, he came back with a ear-to-ear smile. Beautiful country. SAN, I guess I was looking at, so SAN. Okay, so, okay, so we just saw that one. Okay, cool. So yeah, those are my comments, man. I'm seeing everything I saw there. It's not the right investment for me, but maybe for somebody else, especially somebody who's in Spain or in Europe that really has a better sense of that economy. Awesome, guys. So we covered a lot of ground, and overall, I really like where the market's at. It's, I can get used to these gains. I'm not going to pretend to expect that it's just going to go like this for a long period of time. This is a really nice gain for 5 days. It's well over 8%. We'll see how things go from here. I could see it, kind of go up, pull back, and maybe from this point forward, single-digit percentage gain between now and the end of the year. I could see a nice strong pullback, but I don't see any bad news. I take that back. I'm not seeing any big problems. We don't have any big earnings coming. We don't see any big economic indicators coming. If you look at the data, election years in the United States, stock markets tend to go up because politicians want to promise a lot of things. Maybe that has an effect to the upside. We'll see. But I'm glad we took the medicine and saw the market drop a bit. I think we're set to rise from here. And so far, it's been a good year. It's been a good year. Year to date on the NASDAQ, it's 19% to the upside. The S&P is up 16.88%. Beautiful. At that rate, double my money in less than 5 years. So I'm happy with that type of appreciation. All right. So hopefully the stock rally for 2 more weeks. I hope so, man. Right now I'm even for the month of August because I track my performance, within month. And the first couple of days were horrible, and now I'm back to even. I'm good with it continuing and seeing a good gain for the month of August. I was close to saying, well, the month of August is going to be negative, man. But at this point, I'm like, who knows? Maybe make a few bucks on appreciation. I'm making a few bucks on dividends, but with the appreciation, that'd be a bonus. We'll see how things sort themselves out. All right, so I did a video today. I'm going to point you to the video and just kind of end the live stream. It's on, these super investors. There's a lot to learn from these guys. Specifically, I referenced that I looked at Pat Dorsey's fund, and I read Pat Dorsey's book. Excellent book. And I like his investing philosophy. It aligns closest to mine. And I learned a lot from him. Look at the video and you'll see my comments on Pat Dorsey. I love Warren Buffett. Just a lot of things he does, they don't align with what I do, and that's okay. There's some things like Chevron he owns, I own. I didn't buy it because he owns it. I bought it for other reasons, but we both own it. He's been right about Apple. I've been wrong about Apple, but he sold half his position, so I guess I was partially right. And but take a look at the video and visit this site. It's really, really useful. They advertise a lot, but they got to pay their bills somehow. And I really like the stats they put off to the right, because it shows you a lot of super investors are in these stocks. A lot of super investors are buying into these big bets. Thought that was really useful. So take a look at the video, take a look at this website, Datarama. I think you'll find it valuable. So that's it. So we're going to do a couple live streams, one live stream on Saturday, and then we're going to do the community video conference call. If you want to be on the video conference call, you got to let me know over email. I'll send you an invitation. We get on a Google Meets call. You can be on camera, no camera, that's fine. You can speak. You don't have to speak. You can just text your questions if you want, or you can just listen in. We've had really good attendance, and the sessions have been excellent. So please join if you'd like. You're welcome to. Doesn't cost anything. You just got to tell me in advance so I can invite you. Right now we have something like 20, 24 invites. We get upwards of 12 people on the call, and it's a really nice session. And I think you'll find it interesting if you'd like to attend. And I'll do a live stream on Saturday. We'll see if we can pull off a nice green day tomorrow. And it'll be a nice, smooth week. That's nice, because the 2 weeks prior, man, it was exciting. It was exciting for the wrong reasons on some days when we were seeing just big drops in the NASDAQ, big drops in the S&P. But now it's been nice, smooth sailing to the upside. All right, everybody. Thanks a lot for joining. Thanks for all your support, watching the videos, all your comments. Really appreciated. Everybody have a good night. Good luck investing.